TheoTrade, this is Don Kaufman, September 3rd, 2020. Minutes to go to the cash close here on this Thursday with the NASDAQ getting absolutely slammed to the downside. You can go ahead and say it. It's an outright crash. The NASDAQ looking like it's going to stare down the face of about a 6% loss today. A lot of the sell side activity started in some of the overnight trade, but it has been persistent. And they are coming for this thing into the close. I'm going to tell you, on this evening's video, we're going to try to answer the question for you. This NASDAQ, again, this crash, is it over or is it really just going to be the beginning? I'm actually going to get into quite a bit of depth over here because for the first time that we've seen really in months and months, the marketplace has completely revealed itself, and I'm going to explain precisely what that means here. Let's start to break this down. Again, this is a fairly fluid situation. Again, we got about 10 minutes left inside of the trading day with the NASDAQ down almost 700 handles here. The S&P is following suit down about 142, a full 4%. You know what? Before I even detail a little bit more about the NASDAQ and what I said a moment ago, the market kind of revealing its hand, let's actually take a step back and let's start to evaluate a little bit about expected move. Okay, because this is what's going to drive a lot of the professional trade moving forward. So yesterday and last night, we're actually detailing the fact that the SPX was just outside of the expected move. This morning, it opens inside of it. We've actually come now below the bottom edge of the expected move. That's got problem written all over it, and I'm going to tell you exactly why. If I actually cruise into a 1 day, 1 minute, if you take a look at this, all right, first of all, just to display to you how imperative it is to understand expected move. There's people trading out there that never even heard of this, okay? They're infatuated with the fact that the NASDAQ is down, but you have to recognize what actually stopped the market from just outright tanking here is the edge of an expected move inside of the SPX, which is 34.46. That's because hedging activity held us up at that point. Now, once we start to get outside of that expected move, and again, this is the SPX. We'll cover the NASDAQ here momentarily. Once we start to get outside of that expected move, it is on, people. It is game on, because that's when servers are going to have to kick into high gear and actually dynamically hedge. Now, if you're unfamiliar with that terminology, when I say dynamically hedge, what that means is they have to sell into selling. So when we start coming outside of this, and right now, come on, we're just a hop, skip, and a jump. This is not definitively outside. We're a hop, skip, and a jump right back here to the safe place. Where's the safe place? Okay, 34.46 inside of the SPX. Again, this is the SPX. Now, the SPX had a $62 expected move this week. Yeah, lo and behold, it's already moved $140 today. Nevertheless, when we start getting outside this expected move, and outside, let's call it, $20 outside, what has to occur is that trading firms, these are dealers, right? Market makers, dealers, they're going to have to sell into sell-side activity. What do they sell? They sell S&P futures, and you can sell the marketplace into an oblivion when that is going on. So selling into selling, okay, is what goes on outside of the edge of the expected move. Why? Why does that occur? And that's important. It's hedging activity. You have to assume, okay, that market makers are out there and they're selling a ton of premium inside of here. A lot of retail traders buying premium. Okay, we had this huge gamma squeeze to the upside. All of that literally flips over on a dime, and here we are. And again, if you ever question these expected moves, you don't have to look any further than today. I mean, here we are with minutes to go to the close. We have this line we drew on the screen like, last Saturday, and we're spot on. And in a marketplace that you feel is just completely coming apart, and you're like, I don't even know where to go. All you have to do is go to the edge of the expected move, and that's precisely where we're supposed to be. Now, if I flip this over to the NASDAQ, if we take a quick glance over at the NASDAQ, we're going to apply auto expected moves. Guess what? We actually touched the very bottom of the NASDAQ. You want to see where the bottom of that was? There it is. We literally touched the bottom edge inside of the QQQ and bounced off of it. So we're starting to get to answer some of this question here. Is this just about to kick into high gear? Well, we're going to look, again, very much into detail of that. As I said, the marketplace, it kind of revealed its hand in a very, very large way today. Let's start to actually break that down along with the entire marketplace. There's a couple of things that are real standout, but there's one real standout here, and that has to also do with the action inside of the bond market. The bonds are bid up today, but the volume is not necessarily huge, okay, which tells me right off the bat that professionals right now, they're just sitting back, along with me. Okay, I'm just sitting back, and I don't mind telling you this. I didn't do much of anything today. Okay, there we go. 7 orders, 1 fill. I've had 1 fill all day today. All right, and everybody always questions, how'd you do on a day like today? Because come on, I've talked about on these videos at nauseum that I'm short. That's how I did today. Okay, this is just one of the primary accounts. So I'm up just shy of $40,000, $37,000 and change, but I only have about $95,000 being held up in margin today. That does not include, okay, pretty good amount of capital also that I, of course, have over at Tastyworks here. I've got a lot of positions on Tastyworks as well, but just inside of a couple of thinkorswim accounts, again, breaking down the accounts. This is a lot of pairs trade, looking for normalization in the QQQ that actually turned around to the tune of $20,000 today. And then a lot of the trades, of course, that I'm doing day to day here at TheoTrade, I'm up about 16,000 and change on those particular trades. Again, if I net it together, again, people know that I'm short. What a difference a day can make inside of a trading account. As I was saying, though, this is not a lot of professional trade in here. This is very heavy into the retail side of trade. And what tipped the hat off there is the ZB is not necessarily seeing the impact. What that means is that you haven't really had a lot of big money moving. I mean, there's no question, okay, that there's a ton of traders that are involved today. Okay, intraday traders, the algorithms are going nuts, right? Like, look at the volume side of the S&P futures. Here we are at 2.6 million contracts, a little bit of a bid under the marketplace over here. But I want you to know right now, this was not professional trade, okay? Again, even me, I sat here today. That is the lowest number of orders that I've had in months. 1 fill, people. That's it. Captain One Lot rides again. And I'm not here trying to lock anything in, which I'm also kind of tipping you off a little bit that I have some expectations that this may only be the beginning, obviously some sell side activity, but we'll come to that here momentarily. Now, for the bigger portion of this, all right? So as I said, this wasn't a lot of professional trade. The bonds didn't do very much. You did see a lot of professional trade, though, move towards the VVIX. I've been talking about this also throughout the course of the last 2 weeks. The VVIX was skyrocketing before today. Right? The VVIX has already actually taken off to the upside, which is indicative that there was some sell-side activity coming. You saw me over the last couple of days. All I talked about is this is how you strategize. You got to go out. You got to buy as many gamma irons as you could possibly get. You got to get your hands on, okay, these trades. You got to buy in terms of premium. Why? Because we knew that a volatility explosion was going to happen sooner or later, and that didn't necessarily mean we knew it was coming today. And here we are, with the volatility exploding into the upside. Now, time out. As I said, the marketplace turned around and revealed its hand in a big way today, and this is what it revealed, okay? You're now looking at volatility futures. Now, not everybody in here trades volatility futures, and that is fine, right? So what, okay, Don, we're looking at volatility futures. I don't even know what this is, okay? When the markets sell off, people typically buy volatility, okay? And today, what do? They bought volatility, and they bought volatility in a big way. In fact, throughout the course of the day, they were buying volatility, okay? Just people were out there gobbling it up. It's up almost 20%. The VIX is up almost 30%. But when I said that there was a big tip-off here, I want you to zoom in, okay, to early on in the trading day. Now, okay, what you're seeing over here early on in the trading day are big volatility sellers. You're like, wait a second, that doesn't make a whole lot of sense. You just told me they were buying volatility. Yeah, they were buying volatility. Okay? They were buying volatility after people started panicking out of their positions. This, okay, is incredible. What is that? That is a down move in volatility. But, okay, the market opened right there at 6:30 in the morning. Bing, the bell goes off here. I'm on Pacific time. Half an hour into the marketplace, the volatility was all the way down to 27 and change. You realize right now it's at 34. That is a monstrosity of a move. What gives? How could volatility possibly be going down? What was the market doing at that point? Well, let me show you. Let me actually bring you into the NASDAQ. What was the market doing? Well, here's the bell, okay? And here we are, selling off violently. And as we started to sell off violently, the volatility initially went down. I'm going to tell you exactly why. All right, I was actually looking at stocks like Apple. I was looking at stocks like Tesla. There was a flood of calls for sale. They were selling calls with both hands. There were so many calls sold that the market making industry had to actually lower volatility with the marketplace tanking. Ain't nobody seen that one before, have they? Okay, because it's all retail driven. All it's doing is providing evidence that the retail world is in the driver's seat, which is completely insane. But because they actually tipped us off, all right, because they tipped us off, you knew it was going to be a hostile day. This is exactly what I was talking about in last night's video. Because if retail is going to start getting scared, right, they're going to show their hand. I mean, retail, they puke. And guess what? They've been puking all day long here. Now, as retail went and started to bail out of positions, go take a look at stuff like Apple. Okay, and we're going to come down here to option statistics. So if you take a look at Apple and you look at option statistics, right, what I want you to show you is the number of calls traded versus the number of puts. And everybody goes, look at all those calls that traded. Yeah, but you're going to find interesting, though, over here, the puts, okay, traded considerably more than the calls. What you're looking at is called the Sizzle Index. The Sizzle Index, okay, it's 5-day, all right, 5-day. I can write 5-day, okay, average volume in options versus what? Well, it's today's volume versus the previous 5 days. So when I say today's volume, you see that says basically 2.3 million calls traded. You have to put that against like the 5-day average. And today, on the call side, we only traded about 1.5 times the norm. The interesting thing is the number of puts really skyrocketed. It doesn't look like it, okay? Because you know what? Lately, nobody's actually traded any puts. There's the closing bell. Not a minute too soon, too, with a 5% decline inside of the NASDAQ. But with this, and again, I love the closing bell inside of Tastyworks. So with this, you know, you're getting a little bit of a feel looking at this. Again, you're looking at today's option volume in the Sizzle Index versus the previous 5 days. And initially this morning, people flooded in, okay, to sell calls. Then they turned around and they started buying puts. And the second they started buying puts, volatility flew. That's exactly why you see, and I said, the marketplace displayed a whole hell of a lot. You know how many people probably saw this? A couple of professionals, maybe in volatility arbitrage. Nobody in the retail side is catching this. No one. Okay, volatility dipped. And then they turned around because they were selling calls. They're panicking out of their positions this morning. They're selling calls. Then they turned around and did what? Bought puts. They bought puts, and the moment they started to buy puts, volatility took off to the upside. And as they bought puts, the marketplaces came down. What you're actually seeing right now, there's no surprises, the bounce over here because people are ducking out of their positions at the end of the day. Okay, so they went out there, bought puts all day long, and then they go, I just got to get out of this thing, and they end up selling the puts that they bought. Maybe some people made some money, maybe they didn't. But I'll tell you what, that is one heck of a wild trading session. All right, what does this amount to? What it amounts to? Pretty simple. You have a ton of people right now that are deep underwater. There's a lot of call buyers that didn't get out. You know they didn't get out. How do I know they didn't get out? Because all I had to do was go again, look over at Apple. All I had to do was look at Apple. If all those call buyers were getting out of there, there wouldn't be 2.3 million contracts traded. There'd be more like 6 or 7 million contracts traded, right? Then I cruised over to the spiders. Now the spiders, some retail traders trade this, but a lot of professionals. Spiders, look, the spiders are only doing 2.2 times the norm. For such a huge freaking day, we're only doing 2 times the norm over here. People are deer in a headlight right there. They're like, and they don't know what to do on a trading session like this. I'll tell you exactly what they were doing. Earlier today, they were out there originally buying calls in the XLF because it was up. Then they flipped over and take a look at this. Look at the number of puts that were actually purchased right there. Okay, almost 9 times the number of puts traded inside of the XLF. Okay, if they started buying puts in the XLF, people are running scared. From my point of view over here, we may bounce. We may get some wicked bounces. Okay, but the dynamic of the marketplace at this point, with it being down, I think you're actually going to get some traders that are going to start flipping over and they're going to start buying puts. Okay. And when you get this, again, if traders are going to turn around, they're going to start buying puts. And this is retail traders. Retail traders are going to start buying puts. First of all, they don't realize they're buying puts in high volatility because most retail traders don't even look at things like implied volatility to that degree, right? So they turn around and they start buying puts. And if they buy puts, guess how this is going to work? Who sells them those puts? Okay, this is what you need to think about. So if you at home, this is you are buying puts. Who's going to sell them to you? The market maker. Okay, all of a sudden, the market maker is going to sell puts. Okay? And if the market maker is going to sell puts, what does the market maker do? They're now short, okay, puts. And if they're short puts, that is massive positive delta. That makes them hugely bullish. No way that a market maker is going to carry that risk. So what do? They go out there and they sell S&P futures. You've been put on notice right now. This is a very dangerous marketplace. You knew that already. But now, okay, if you go out as a retail client and you're buying puts thinking the market's going to continue to go down, you're actually going to perpetuate your own down move. The problem that we have in the next couple of days, though, we have tons of people that have bought calls. They have tons of people that have bought calls, and they may not be out of them. Again, all they did is the deer in the headlights. This will come back. This will happen. Maybe we do see some dip buying over here. But rest assured, at this point in time, with almost a 5% down move in a day, if they come in and they buy the dip, there's so many people that just want to get back to even that they're going to start blowing out of positions, and you're going to see some wicked sell side. For here on out, for the next few days, sell the bounces. Sell the bounces. I didn't say buy the dips. I said actually sell the bounces. Sell some of the bounces. Let's get through some of the order flow. Let the marketplace actually show its hand a little bit more. Again, some damage was inflicted. All right, and there's no question some damage was inflicted over here. But once volatility has reared its ugly head, there is going to be considerably more to come. Huge trading opportunities for those of you that know how to take advantage of this. Thanks, everybody, for joining us here at TheoTrade. Have a wonderful evening. Bye-bye.